students. Welcome to the lecture on investment planning, and after the lecture we will be able to learn the following objectives. Discuss the meaning of investment, explain speculation and gambling, discuss investment avenues, define the types of investment, describe the investment objectives and investment process, understand the money market's instruments, define investment vehicle, explain the investment markets and regulation. Let's start with a brief introduction of investment planning. Investment planning is the process of matching financial goals and objectives with investment resources. It is critical to note that investment planning is a subset of financial planning. Investing money takes a great deal of time, tools, and resources. Much of the time, tools and resources are required because financial planning must come first. Without a financial plan, we do not have well-structured financial goals. Without well-structured financial goals, we will not have well-defined investment objectives. Without well-defined investment objectives, how can you invest successfully? Investment planning is a process, not a one-time event. It's a lifelong endeavor that will have twists and turns and knock you on your head once in a while. Business investment returns. Business investment opportunities are largely contingent on the prospective rate of return or profit of a proposed business venture. The return on investment, ROI, is the ratio of money gained to the amount of funds invested. The rate of return from a business investment is more than a function of the expected cash flows and capital appreciation. Creation of business investment opportunities. At the international level, the World Bank Group lends around $15 to $20 billion every year to finance developmental projects in the third world countries. The International Bank for Rural Development, IBRD, International Finance Corporation, IFC, and Multilateral Investment Guarantee Agency, MIGA, offer specific products such as bonds, loans, and guarantees to potential investors for financing development in the emerging and underdeveloped economies. Let's talk about the meaning of investment. Investment assets that consumers buy are of two major types: personal assets and investment assets. Personal assets are bought primarily for the usage and creature comforts they provide. These include such items as homes, cars, and clothes. Investment assets are those acquired for investing, defined as the purchase of an asset with the expectation that the asset will provide a return associated with its risk.
You're hearing your friends and parents talk about investments, and you may be unclear about what an investment is. As an investment specialist, I am surprised at even how many adults lack understanding of what an investment truly is. To understand investments, we must also learn about assets. Like investments, assets are similar and sometimes seem to be the same thing, but they are in fact different. Assets are things that have value and have the ability to make, lose, or retain their value. This represents things like money, a car, furniture, and art. Investments also have value and the ability to make, lose, or retain their value. Unlike assets, however, they produce additional monetary worth. Think of a company that makes a product and sells it to you and me. The product is the added value created by the company. Now let's test your knowledge. Is an ounce of gold an asset or an investment? If you said asset, you are correct. Lots of people misunderstand this concept, but here is why. If you take an ounce of gold and put it in a safe for 30 years and later take it out, it's still just an ounce of gold. It didn't produce anything, even though it might be worth more than when you first put it in the safe. Let's try another one. Is a house that you live in an asset or an investment? If you said asset, you are correct. If, however, you decide to rent the property out to another family and charge them rent, it then becomes a rental property or a real estate investment. Remember that assets, like investments, can have their value change over time, but only when the asset creates additional monetary worth outside of the hard asset does it become an investment. One more. Is a treasury bond an asset or an investment? If you guessed investment, you're correct. Treasury bonds are a form of debt owed to you by the government. The bond itself has value and it can fluctuate.
Here we will discuss about speculation and gambling. Gambling and speculation are popular among those who want to make easy money. Gambling. If we want cash within a snap, maybe gambling can help us with that. When one says gambling, it would usually connote casinos, lotteries, and slot machines. And every time we gamble, there are only two things we can expect. It is either we win or we lose. This has been popular because we only have to spend a small amount of money for stakes that are very high. Speculation. If one wants to increase his chances to profit, one might try to speculate. Speculation is just like investment. We initially put in a capital expecting a profit in return. This is also defined as the act of placing funds on a financial vehicle with the intention of getting satisfactory returns over an amount of time. The stock market is a widely known rendezvous for speculators. Now, we shall understand the investment avenues. Equity. Equity is an investment avenue which is able to offer the highest possible returns, but is very risky as there are huge probabilities of investors even losing some part of the invested capital as well. Mutual funds. Mutual funds offer moderate returns, but are less risky compared to equity investments. They can offer a return between 12 to 30% annually in good times. Bonds. These have lower risks, so offers lower returns. The return from bonds ranges between 7 to 10% annually. Commodities. These investments are made in commodities such as rice, wheat, metals. This is very tricky investment. Return from these investments varies between 10 to 35%. Bullion. Bullions are part of commodities. One can invest in gold, silver, and platinum. These fetch high returns, but are also very volatile. Futures and option. These investments can offer 5 to 10% return even in a day. This market is also very tricky. Real estate. One can also invest in real estate. This investment offers attractive return, but the price fluctuation in bad times is very high, and one needs lakhs of rupees to get started in this market. Fixed deposits. One can opt to invest in fixed deposits. The investments into fixed deposits offer normal returns and low risks. The investment into fixed deposits is available in forms of bank fixed deposits, post office fixed deposits, and company fixed deposits. Government and RBI bonds. These offer fixed rate of return over a period of time. Company bonds. These are the same as government bonds. The only difference is that these are more risky. Post office investments. These are the risk-free investments and offer lower return. Insurance. Insurance has become one of the most important investment avenues. Unit-linked insurance plans are very popular besides the traditional endowment policies. Provident funds. This one is the safest long-term investment option. This is mainly for retirement purposes. Let's now take a look at the types of investment. The word investment has become muddled with overuse. Referring to a stock or a bond as an investment is still in regular use, but now people make investments in their education, their cars, and even their flat screen TVs. Investors can be classified into the following types: aggressive, moderately aggressive, moderately conservative, and conservative. Aggressive investors tend to concentrate on equity investments such as individual stocks and mutual funds. They are open to more risk, willing to see large short-term swings in market performance on an annualized basis. Moderately aggressive investors also seek longer-term investment gains through a mix of equity investments. While many of the investments are the same, the overall portfolio contains some more conservative investments. Creating a portfolio that builds wealth with less annual swings in the portfolio's performance. Moderately conservative investors are much less willing to accept variations in their portfolio's balance. A moderately conservative portfolio is more often weighted to individual bonds or bond mutual funds and can expect to earn between 6 to 8% in annual growth. Conservative investors are typically those with either a short-term goal or those who are in retirement seeking a regular income stream. These portfolios tilt away from the equity investments into more preservation investments like real estate investment trusts, individual bonds, bond funds, municipal bonds, and annuities. Here we will discuss about investment objectives. The options for investing our savings are continually increasing, yet every single investment vehicle can be easily categorized according to three fundamental characteristics: safeties, income, and growth, which also correspond to types of investor objectives. Safety. The safest investments are usually found in the money market and include such securities as treasury bills, T-bills, certificates of deposit, CD, commercial paper or banker's acceptance slips, or in the fixed income bond market in the form of municipal and other government bonds, and in corporate bonds. Income. The safest investments are also the ones that are likely to have the lowest rate of income return or yield. Investors must inevitably sacrifice a degree of safety if they want to increase their yields. In order to increase their rate of investment return and take a risk above that of money market instruments or government bonds, investors may choose to purchase corporate bonds or preferred shares with lower investment ratings. Growth of capital. Growth of capital is most closely associated with the purchase of common stock, particularly growth securities, which offer low yields but considerable opportunity for increase in value. For this reason, common stock generally ranks among the most speculative of investments, as their return depends on what will happen in an unpredictable future. Secondary objectives. Tax minimization. An investor may pursue certain investments in order to adopt tax minimization as part of his or her investment strategy. Making contributions to an IRA or other tax-sheltered retirement plan, such as a 401k, can be effective tax minimization strategy. Marketability, liquidity. Money market instruments may only be redeemable at the precise date at which the fixed term ends. If an investor seeks liquidity, money market assets and non-tradable bonds are not likely to be held in his or her portfolio. Now we shall understand the investment process. The investment process outlines the steps in creating a portfolio and emphasizes the sequence of actions involved, from understanding the investor's risk preferences to asset allocation and selection to performance evaluation. The investment process emphasizes the different components that are needed for an investment strategy to be successful, and by so doing, explain why so many strategies that look good on paper never work for those who use them. The next part of the process is the actual construction of the portfolio, which is divided into three subparts. The first of these is the decision on how to allocate the portfolio across different asset classes, defined broadly as equities, fixed income securities, and real assets. The second component is the asset selection decision, where individual assets are picked within each asset class to make up the portfolio. The final component is execution, where the portfolio is actually put together, where investors have to trade off transactions cost against transactions speed. Best long-term investments. The best investment is one which poses the least risk but yields high returns. Know the various options that are available for long-term investments, evaluate risks, and plan investment accordingly. Investors with a long-term outlook for consistent yearly returns is undoubtedly an important criterion to choose an investment avenue. It determines the investment strategy, and for most investors, it is one of the most important criteria for selecting an asset. Categories of investment assets. Cash equivalents. Since nearly everyone needs to make transactions and have readily accessible money in case of an emergency, many individuals use instruments known as cash equivalents. Typically, cash equivalents either have no specified maturity date or have a date 1 year or less in the future. Bank deposits. The most widely known cash equivalent investments are savings accounts and non-negotiable certificates of deposits, CDs, at banks, savings and loans, and credit unions. These investments are usually insured to a limit of $250,000 by the Federal Deposit Insurance Corporation, FDIC, and thus carry minimal risk. Let's now take a look at money market instruments. Money market deposit accounts, MMDAs, and money market mutual funds, MMMFs, are other popular cash equivalents. For both types of investments, minimum initial dollar amounts are typically required to open the account. Treasury bills. Another popular cash equivalent investment in U.S. Treasury bills. T-bills. With this backing, T-bills are the safest investment available and thus pay investors the lowest interest rate of the various money market instruments. Governmental debt securities. Governmental debt includes securities of the federal, state, and local governments and their agencies. Some federal bonds are backed by the full faith and credit of the U.S. government. A few of these agency bonds have guarantees that effectively place the full faith and credit of the U.S. Treasury behind the bonds. Some state and local government bonds, known as general obligations, GOs, are backed by the taxing power of the state or local government. Corporate debt securities. Corporations are major issuers of debt instruments. These securities have various characteristics detailed in the indenture. The indenture is the legal contract associated with a bond issue, written by the issuer that specifies the rights and protections afforded to the bond investor. Equity securities. Equity investments represent an ownership position in a business. As such, they represent a higher risk for the investor than do the debt investments. Corporations acquire equity funds by selling ownership shares to either a few individuals or to the public. Common stock. Each common share receives an equal portion of the dividends distributed as well as any proceeds that remain after liquidation. Common stockholders sometimes have a preemptive right, which is the right to maintain their relative voting power by purchasing shares of any new issues of common stock of the corporation. Let's now take a look at the investment vehicle. An investment vehicle refers to anything that a person can invest his money in. The premise behind selecting an investment vehicle is to identify an investment that will allow money to grow while minimizing the risk of losing the funds invested. Stocks and bonds are the two most commonly recognized investment vehicles. Stocks refer to an ownership stake in a public company. Investors can then purchase shares of the stock for the market price. Bonds, on the other hand, refer to the purchase of debt. Treasury bonds issued by the government, for example, are essentially loans to the government or a purchase of the government's national debt. Certificates of deposit are also an investment vehicle, as are money market accounts. These tend to be the lowest risk type of investments, but have the lowest expected rate of return. Let's now take a look at the investment markets and regulation. Many types of markets exist for investments. This will first describe major types of markets where investments trading occur on a regular basis. These markets are 1. True auction markets. 2. Negotiated markets. 3. Dealer markets. And 4. Organized securities markets. True auction markets. In true auction markets, investment assets such as artwork, collectibles, or real estate are offered for sale to the highest bidder. The bidding continues until no one exceeds the last bid price. Negotiated markets. Negotiated markets predominate the trading of real estate and similar investment assets. In these markets, sellers list their offerings with brokers who seek to attract buyers through advertising and other marketing methods. After a buyer has been located, negotiations determine the price. Dealer markets. For many securities, one or more dealers make an active market by offering to buy and sell as much of a particular security as desired by investors. The dealer makes the market. When demand for the security rises, the dealer raises the bid and asks prices. When demands fall, the dealer lowers these prices. Organized securities markets. Each security is assigned a trading post on the floor of the exchange where commission brokers employed by the various stock brokerage firms meet to engage in auction trading for the buy and sell orders transmitted to them. Regulation of the markets. Securities Act of 1933. The Securities Act of 1933 requires issuers of new securities to file a registration statement with the Securities and Exchange Commission, SEC. No attempt to evaluate the investment merits of the proposal is made by the SEC. Rather, the SEC merely seeks to verify that the statements are accurate. Securities Exchange Act of 1934. As the name implies, the emphasis of the Securities Exchange Act of 1934 is to regulate the various securities markets. Its scope includes the organized securities exchanges, the over-the-counter markets, all stock brokers and dealers, and the securities traded in these markets. In addition to requiring registration with the SEC, this act requires these institutions, individuals, and issuing corporations to file periodic updated data with the SEC. The Investment Advisors Act of 1940. The Investment Advisors Act of 1940, as amended by the Investment Supervision Coordination Act of 1996, requires that investment advisors register with either the SEC or state regulatory authorities, depending on the amount of assets under the advisor's management. Investment Company Act of 1940. The Investment Company Act of 1940 established rules and regulations that apply to all investment companies with respect to their dealings with their shareholders. This act requires investment companies, 1, to provide adequate disclosure to shareholders, and 2, to refrain from charging excessive advisory, management, or brokerage fees. Securities Investor Protection Act of 1970. The Securities Investor Protection Act of 1970 is when Congress set up the Securities Investor Protection Corporation, SIPC. It is patterned after the Federal Deposit Insurance Corporation, FDIC, with the objective of protecting investors' property. SIPC coverage also includes protection against unauthorized trading in a customer's account. Now, in the end, let us summarize what we have learned in this lecture. Equity is an investment avenue which is able to offer the highest possible returns, but is very risky, as there are huge probabilities of investors losing some part of the invested capital as well. Aggressive investors tend to concentrate on equity investments such as individual stocks and mutual funds. A systematic investment plan, SIP, is an investment plan in which someone invests a set amount of money in a given investment at regular intervals. Business investment opportunities are largely contingent on the prospective rate of return or profit of a proposed business venture. The return on investment, ROI, is the ratio of money gained to the amount of funds invested. A defensive investment strategy is one that includes a portfolio of investment options designed to minimize the risk of losses to the investor. Popular choices for a defensive investment strategy include bonds, currency, very safe stocks, and perhaps precious metals. An investment vehicle refers to anything that a person can invest his money in. There are numerous types of investment vehicles for those looking to invest their money.